mid-year outlook's just dropped, I think, a couple of minutes ago, so thanks for coming on straight afterwards with us. Your highest conviction overweight, I think, is Japanese equities. You've maintained this overweight on US equities as well. Let's start with the US, and then we can move over to Japan. Walk me through the US call, what really underpins, what the biggest pillar of that call is.
Absolutely. So we can look at the cyclical factors. If we look at kind of the first half of the year, we have had positive surprises on earnings driven by AI. We had negative surprises on rates driven by Fed repricing. As we look ahead to the second half of the year, maybe we have less negative surprises from rates, maybe even positive as we head into rate cuts, but less positive surprises on earnings just because the bar has risen. But the bigger picture is, which is something that we lay out in the outlook, we've got to look beyond the cyclical ebbs and the flows and really focus on the transformations that are happening around us. So AI is driving that, but the low carbon transition is driving that as well. When we add up the capex numbers from these transitions, from these transformations, we're talking about magnitude comparable to the industrial revolutions, comparable to the internet revolutions. So we really think that we're moving from the financial economy to the real economy, and investing needs to change as well. It doesn't mean, given the elevated uncertainty, we need to de-risk. In fact, we need to properly use risk budget to lean into the transformation, but it does mean that we're going to be more selective, be more active, and private market plays a bigger role.
You offered some historical examples. Let's dig into that just a little bit more. Sometimes you can identify the mega force with ease. How easy is it to sort of identify the winners of these mega forces? Just taking the internet as an example, the internet was a big deal, but sometimes it was difficult to identify who would be the ultimate winners of that mega force. How easy is it this time around?
It's hard. It's hard. It's highly uncertain. So if we think about the various forces that are playing out, it actually means that as we look ahead to the future, there is an unprecedentedly wide range of outcomes possible. So no longer can we think about investing around a central base case with deviations around it, but we need to think about it in terms of scenarios that can be very different from each other, that may have very little overlap with each other. So that's how we kind of rethink investing and portfolio construction as a whole. But as we think about kind of identifying winners and losers, because this is an environment that does create more winners and more losers, we need to think about it in sequencing, in stages, right? So phase one of AI is really around AI build out. So this need for energy competition, arms race for energy and data center build out. And phase two is around really kind of the broader adoption, companies building out their AI capacities. We're seeing healthcare already doing that. Phase one and two can both be inflationary because we're talking about creating demand before the benefit on the supply side and productivity side can really come through. Phase three is around productivity boom, but that's hugely uncertain, and it cannot happen if phase one and two does not happen. So it will have to be inflationary first before it can be deflationary.
Which is the reason why when you talk about going long high quality bonds, you're talking about short term. Before we get there, before we get to Japan, I know we should get there, but I really want to dig in with the idea of AI being a trade that is very hard to sort of distinguish. You have Citigroup talking about how some of the AI-exposed high flyers are probably overbought. We've been hearing the B word, bubble, in, say, certain stocks like NVIDIA. Does the AI trade include some of those names that have already gotten bid up dramatically?
Yes, at the current juncture, yes. So our U.S. equity overweight also include the tech sector overweight, telecommunication, communication services overweight as well. But we are starting to broaden out our kind of AI play as well. So the initial beneficiaries are the likes of Magnificent Seven. And just to note, their earnings have come through. Their earnings have been revised a lot, and they have actually give or take delivered, if not beat expectations. So valuation is not as stretched as the price appreciation would suggest. But as we think about kind of the phase two of AI implementation, as broader sectors starting to adopt AI and benefit from the gain, efficiency gain, we have sectors like financials and healthcare and industrial as well positioned for the AI infrastructure build out. We want to include them in our AI play as well. And if we look at kind of the earnings picture, the last earnings season. We had 8 out of the 11 sectors growing their margins, which is incredible, showing a sign of broadening out. Looking ahead, tech is still expected to lead, but sectors like energy and healthcare are also expected to drive earnings growth in the second half of the year.
Okay, so just a really short bit on Japan. I know that that's your biggest overweight. I wonder how much this is sort of betting on a Bank of Japan rate-cutting cycle that isn't necessarily a rate hiking cycle, excuse me, that isn't exactly tightening, but is an adjustment to deal with where the yen's at.
I would say that our Japan core is actually mostly a micro core at this juncture. The macro story, exiting deflationary decades and benefiting kind of from the macro lift, inflation coming back, we have already benefited from that. Now we're looking at companies delivering earnings. Expectations are for Japanese equities to grow earnings by 7-8% in the coming 12 months. We think that they can do better. You look at the latest AGM season, corporate governance, shareholder reform, that's progressing as expected. The currency, we talked about it not that long ago, is somewhat inconvenient because it's so volatile. It has been very, very weak. In part, it's helped earnings upgrades for manufacturing part of the Japanese equity market, but more broadly for foreign investors, it's just so volatile. It's gotten to a point, initially weaker currency was helpful for Japan achieving their inflation targets. Now, as we head into kind of election cycles in Japan as well, both for the party as well as for the country next year, it's less helpful. So I think there will be policy, we're not talking about explicit intervention, but maybe encouraging repatriation of foreign ownership back into Japan, maybe attracting foreign inflows that could help with the currency stabilization.